Hi friends, welcome back to my channel Modern Quantity Surveyor Key Skills to Have. We are still on this competency number 5 about accounting principles and procedures, and today you will learn a very important topic on how to improve the accuracy of a cash flow forecast. So this is just part 1 of the video. Improving the accuracy of cash flow parameters in constructions is essential for effective financial management and project success. Just as weather forecasting combines art and science, cash flow forecasting involves blending historical data with current project details to estimate future financial needs. So, let's look at the information required to improve the accuracy of a cash flow forecast. Now there are almost 21 points we will discuss. So let's begin. First one, contractor versus employer's approach to cash flow forecasting. Employers and contractors approach cash flow forecasting differently, focusing on varied factors like payment dates and presentation. For example, employers may retain funds from contractors, while contractors may not retain from subcontractors. Next, identifying the employer's brief for the cash flow forecast. Before conducting a cash flow forecast, it is crucial to gather a brief from the employer to ensure it meets their needs. Key questions include: who is the forecast for, employer or contractor? Should it cover the entire development or just the construction contract? What dates and values should be shown? And different contract payment terms affect cash flow. So, employers must specify dates, valuation, certificate, invoice or payment in forecast to prevent funding shortfalls. The next topic is about identifying project program start date or end date. The project program's accuracy depends on the current design status. Early stage programs, they are often aspirational, while those developed post-contractor appointment are more advanced. Accurate cash flow forecasts rely on high quality program data, so thorough investigation is essential. Even at early design stages, contractor input can be valuable. Separate enabling and main work contracts, especially if overlapping or of significant value, should have individual cash flows that are combined for a complete forecast. Construction and project value. A cash flow forecast can be based either on the construction contract value or the overall project value. The construction contract value typically covers payments to the main contractor and usually excludes fees, VAT, direct contracts, etc. Therefore, discussions with the employer or requester are crucial to ensure all necessary information is included. Understanding subcontractor trades and the distribution of their package values is also important for accurate forecasting. Also, for example, in case of electrical services, the early work includes first fix and cabling, followed by equipment delivery and final light fittings. So the cash flow forecast should account for these stages value distribution, and this applies to many packages with the high value items in extended programs. So as a quantity surveyor, we need to have a very solid understanding of the building processes for the accurate forecasts. Adjustment for cyclical events, holiday periods, industry shutdowns, winter working, etc. So when plotting time data from the program, it's essential to account for the cyclical events affecting site progress, such as Christmas, Easter and other public holidays, as well as project-specific events like school exams. Sensitive projects may require night or weekend work, which should also be included in the forecast. While less predictable factors like adverse winter weather are challenging to forecast, the overall program should consider seasonal variations. Public holidays like Christmas and Easter. So, Christmas and Easter significantly impact a project's cash flow. The construction industry, particularly subcontractors and suppliers, often shut down for 2 weeks over Christmas, which can affect the cash flow. Valuations may need to be completed earlier in December to avoid the shutdown, resulting in earlier payment dates in January. While this minor adjustment might not greatly affect early stage forecasts, it can significantly impact clients relying on cash flow forecasts for funding drawdowns. Next step is about retention percentage and period. So many construction contracts, as you know, include a retention provision, typically a percentage of 3 to 5% of the construction value or a fixed sum. A portion of this retention is returned at practical completion, with the remainder due after the defect liability period, usually 6 to 12 months. An accurate cash flow forecast will have to take account of retention, especially when showing the net payment at the end of each interval. So, there will be a long period between practical completion and the final certificate where cash flow remains unchanged, followed by a final increase at the end when the last part of the retention is paid. Next is about the rectification period or defects liability period as well. So this rectification period or defects liability period often retains a portion of retention, usually 6 to 12 months after practical completion. This impacts the cash flow forecast significantly, as a large part of the retention, often half, remains with the employer. For example, in a 10 million project with 3% retention, the client retains €150,000 after practical completion. Contractors must account for this retention in their cash flow management, and subcontractors and suppliers face similar delays. So, if the contractor fails to address defects properly, the employer may hire another contractor and deduct the cost from retention. Certification period, that is delay from valuation to certificate. Now, the certification period is the time between a valuation being issued by the quantity surveyor and the payment certificate being issued. Values on the certificate may differ from the valuation if the contract administrator finds discrepancies. Therefore, use certificate values for plotting actual payments against forecasts and not the valuation amounts. Also, interim certificate dates should be scheduled up to 1 month after practical completion. Contractors can submit payment applications up to 7 days before the certificate date. Although it is common for the main contractor to provide interim valuations, the quantity surveyor is ultimately responsible for valuing the works. Just to give a hint about the interim certificate, this is a document issued periodically during a construction project to certify the value of work completed up to a certain point. The payment period, which is delay from certificate to the payment. Now, the payment period refers to the delay between issuing a payment certificate and making the actual payment, typically around 14 days in standard contracts. And this period can vary with client amendments, so accurate timescales are crucial when preparing the cash flow forecast. In the next video, we will look into the remaining necessary items which are important for improving the accuracy of the cash flow forecast. So just the tip here, the key to reliable cash flow forecasting lies in integrating precise data, understanding risk factors, and continuously monitoring progress against forecasts. So learn at least one competency a week, and the reference is RICS cash flow forecasting for this information. Thank you so much. Please subscribe to my channel.